Hello everyone, welcome back. In our last session, we talked about the business environment. Today, we move to a very practical topic, Principles of Managerial Accounting. Managerial accounting is about using numbers, costs, budgets, and reports to help managers make better business decisions. By the end of this session, you'll understand the main tools that managers use every day. Let's start. Let's look at our 4 objectives for today. First, we will define managerial accounting and explain why companies use it. Second, we will compare it with financial accounting, so you understand the difference clearly. Third, we will learn how to classify costs by behavior and by function. And finally, we will apply cost-volume profit analysis, a simple but powerful tool to a real business decision. Let's begin with the definition. So what exactly is managerial accounting? Look at the definition. It is the process of preparing financial and cost information for managers inside the company to help them plan, control, and make decisions. A simple way to remember it is accounting information built for people inside the business, not for outsiders like investors or banks. Now, look at the cycle on the right. Managers use this information in 3 steps. First, they plan, setting goals and budgets. Then, they control, monitoring costs and results. And finally, they decide, choosing the best action for the business. This cycle repeats continuously. Now let's compare managerial accounting with financial accounting because students often confuse the two. On the left, financial accounting. These reports are for people outside the company, investors, banks, tax offices. They must follow strict accounting standards. They show what already happened in the past and they report on the whole company together. On the right, managerial accounting. These reports are for people inside the company, managers and department heads. There are no fixed rules, so the format is flexible. It focuses on the future for planning and it can report on just one product, one team, or one project. Keep this difference in mind. It will help you understand the rest of today's topic. Managers need to classify costs before they can control them. The first way to classify costs is by behavior, how a cost reacts when production changes. Fixed costs stay the same no matter how much is produced. For example, monthly rent. Variable costs change directly with production. For example, raw materials. If you produce more units, you spend more on materials. Mixed costs are part fixed and part variable together. Look at the example at the bottom. A factory pays 5,000 Algerian dinars rent every month. That part is fixed, plus 2 Algerian dinars for every unit produced. That part is variable. Together, this is a mixed cost. Costs can also be classified by function. In other words, how easily we can trace a cost to one specific product. Direct costs are easy to trace to one product. For example, in a furniture factory, the wood used for a table is a direct material, and the carpenter's wages are direct labor. These costs clearly belong to that one product. Indirect costs are shared across many products. For example, factory rent, electricity, and the supervisor's salary cannot be traced to just one product. They support the whole factory. We often call these costs manufacturing overhead. Understanding this difference helps managers calculate the true cost of each product. Now let's look at one of the most useful tools in managerial accounting, cost-volume profit or CVP analysis. CVP analysis studies the relationship between costs, sales volume, and profit. The key concept is the break-even point, which is the point where total revenue equals total cost. At this point, the company covers all its costs, so there is neither a profit nor a loss. On the left, you can see the formula used to calculate the break-even point in units. In this example, the fixed costs are 10,000 Algerian dinars. The selling price is 50 Algerian dinars per unit, and the variable cost is 30 Algerian dinars per unit. As shown, the company needs to sell 500 units to break even. On the right, the graph illustrates this concept. The revenue line and the total cost line intersect at the break-even point. Before this point, the company operates at a loss. After this point, it begins to make profit. Another key tool in managerial accounting is budgeting. A budget is simply a detailed financial plan for a future period of time, for example, next month or next year. There are several types of budgets. The sales budget forecasts expected sales in units and revenue. The production budget plans how many units need to be produced to meet those sales. The cash budget tracks cash coming in and going out, so the company doesn't run out of money. And the master budget combines all of these smaller budgets into one complete plan. Look at the example. A bakery forecasts selling 2,000 cakes next month, so it can plan its ingredient purchases and staff hours in advance instead of reacting at the last minute. Managerial accounting is not only about recording numbers, it directly supports decision making. One key idea is relevant costs. These are costs that differ between two choices and will affect the future decision. Importantly, some costs, money already spent in the past, are never relevant because they cannot be changed. Managers should ignore them when deciding. Look at the example on the right. A phone company needs a small component. Making it in-house costs 8 Algerian dinars per unit, but buying it from a supplier costs only 6 Algerian dinars per unit. Using relevant cost thinking, buying is the better choice. It saves 2 Algerian dinars for every unit. This is a classic make or buy decision, and it shows how managerial accounting guides real business choices. To finish, let's put everything together with one real example. A small furniture manufacturer. This company classifies wood and labor as direct costs and rent as indirect costs. It calculates a break-even point of 300 tables per month. It builds a sales and cash budget for the next quarter, so it always knows how much money it needs. And it uses relevant cost thinking to decide to buy table legs from a supplier instead of making them in-house. You can see how one single company uses several managerial accounting tools together. This is exactly what happens in the real world. On the right, remember our 3 key takeaways. Managerial accounting supports internal planning, control, and decisions. Costs must be classified before they can be managed or compared, and tools like CVP, budgets, and relevant costs guide daily choices. Thank you for your attention. Now let's open the floor for your questions.